Hi everybody, this is James with the John Miller Real Estate Team and Keller Williams Realty in Westboro, and I'm here to explain the differences between an assessed value, an appraised value, and a market value of a property. And that's something that comes up all the time. When I'm showing buyers homes, they say, well, what is the property assessed at? And I have to kind of explain to them the difference between an assessed value and a market value. So the big thing about an assessed value is the assessed value is the dollar value assigned to property for assessing taxes. Now that doesn't take into account condition of the property at all. It's, as an example, if they didn't pull a permit to put on a large deck, that wouldn't be in the assessed value. If the house is really run down and it's been vacant for years, that wouldn't be part of the assessed value. The assessed value is almost strictly based upon square footage and land area of the house, and that is taken into account throughout the entire town, and the town is given a value of the property based upon that, and in turn that is what the town collects their taxes of the property on. In addition to that, each town has their own tax value. So one community could have a tax rate of 1% of the assessed value, and another community could have a tax value of 1.5%. So it can differentiate, and that definitely affects your mortgage payment as well. The appraised value is the dollar value of a property based upon the opinion of a licensed appraiser. And banks will send out an appraiser anytime you're getting a loan. Banks will send out an appraiser to figure out the condition, the square footage, any add-ons. Maybe the house has a jacuzzi, granite countertops, things like that that won't show up just on the assessed value. The appraiser takes that into account and gives a dollar value to those different points of the property that didn't come up in just the assessed value. Now, sometimes banks will, a low appraised value will definitely affect a buyer's ability to purchase a property. That is because the loan amount would seem too high with respect to the value, and unless the buyer can come up with the difference, the buyer will be unlikely to get a loan for the property. And then the third thing is actually market value, and that is the dollar value of property based on what a knowledgeable, willing, and unpressured buyer would pay to a knowledgeable, willing, and unpressured seller in the current market. So that's someone that wants to sell but doesn't need to sell. And that's someone that wants to buy but doesn't need to buy. So it's a meeting of two minds, coming to an agreeable price of a property. I want to give some examples of a pressured buyer would be, or a pressured seller would be the bank. They want to get the property off of their books. So they're saying, we don't want this anymore. We don't want to pay taxes. We don't want to maintain the lawn. We don't want to, there's break-ins, whatever the issue is. The bank would be a pressured seller because they just want to unload the property. Foreclosure is very similar to a bank-owned. Some examples of a pressured buyer would be a seller that is selling his existing home and he has a certain number of days to purchase the property. The same thing on the seller's side. If the buyer has an accepted offer, he needs to sell his property within a certain amount of time or get it under agreement. So he may be willing to take a lower price, to get that under agreement, so he can follow through with his transaction. So those are the differences between the assessed value, the appraised value, and the market value. If you've got any more questions, you can definitely call us, email us. Go to our website. You can watch some more videos here on the side of your screen. It's James Giguere, Keller Williams Realty Westboro, and the John Miller Real Estate Team. Thank you.